The U.S. economy enters 2025 with an optimistic outlook but could face a number of familiar obstacles and challenges, CNBC writes. High interest rates, a possible weakening labor market and likely political instability in Washington are just some of the challenges facing the nearly $30 trillion economy. Nevertheless, consumers continue to hang in there despite persistent inflation, corporate profits are expected to be strong again, and businesses see a more favorable outlook after a change in government. All of this is contributing to a positive mood on Wall Street ahead of the new year. There's a high probability that the economy will accelerate in 2025 and continue to exceed expectations, said Joseph Brusswelles, chief economist at RSM. This is the economy we want. This is the economy we need. In the scenario that Brusswelles considers most likely, real GDP would show 2.5% growth next year, slightly below the 2.7% expected for the current year. He calculates that the probability of this scenario is around 50%. In fact, the next most likely scenario he predicts is growth above 3%. The expert estimates the probability of a recession at just 15%. These numbers exceed the Fed's 2.1% growth forecast and the 2.2% estimate from a survey of professional forecasters. This is still in line with the overall positive outlook for both the economy and the stock market. The drivers will remain the same according to Brusswelles. The main drivers will be strong household consumption, absolutely solid and fixed business investment. In addition, I am very optimistic about the productivity-enhancing investments in hardware, software and intellectual property that companies are making to prepare for the AI revolution. There is a real investment story embedded in the economy that portfolio managers really need to keep a close eye on, he added. A lot of economic news lately has revolved around President-elect Donald Trump's program of tax cuts, reduced regulation and tax incentives, as well as the expected amount of government spending on areas such as energy exploration and AI. However, these initiatives are likely to be the story of 2026, as it is increasingly likely that Trump will face stiff resistance in Congress, especially on the spending side, as he tries to push his agenda. Rather, near-term growth may be driven by continued technology innovation and business investment, as well as consumer resilience. Equipment spending grew strongly in 2024, posting gains of 9.8% and 10.8% in the second and third quarters, respectively, according to the Commerce Department's Bureau of Economic Analysis. Consumer spending also looked good despite rising prices, with retail sales up 3.8% in the year through November. Corporate earnings are also expected to have another successful year. Companies in the S&P 500 index are projected to grow 14.8%, nearly double the average for the past 10 years, according to FactSet. In our baseline scenario, we expect solid economic growth in the U.S., supported by healthy consumption, loose fiscal policy and lower interest rates, UBS said in its Outlook report for the year. We believe that many of the key factors that have supported U.S. economic growth in recent years are likely to persist. Stock market analysts, for their part, expect strong returns in 2025. The average consensus forecast for the S&P 500 index is 6,678, which would imply about a 12% increase from current levels. What's ahead? Certainly, a number of key growth drivers are on somewhat shaky ground. Concerns about the state of the labor market remain. While hiring remains largely stable, it has slowed considerably. The unemployment rate is also low, but the number of unemployed continues to rise, with those out of work for 27 weeks or more at the highest level in November since January 2022. While the hiring rate continues to rise, the pace has slowed considerably. The number of layoffs is also low, but the long-term unemployment rate has been steadily rising, with those unemployed for 27 weeks or more reaching the highest level in November since January 2022. We don't yet have an adequate explanation for why this is happening, says Brusswelles. We have an interesting intersection of technological disruptions that are probably affecting the labor force, and we want to go slowly and methodically to try to understand that as close to real time as possible. Other big threats include the interplay of interest rates, inflation and Fed policy. Most recently, the Fed raised its 2025 inflation forecast to 2.5% and now doesn't expect to reach its 2% target until 2027. Nevertheless, in September, the regulator began what initially appeared to be an aggressive path of interest rate cuts, reducing the cost of lending by 0.5% at once. While the central bank made additional quarter-point cuts in November and December, the future outlook is less clear. In fact, futures traders expect only 1 or 2 further cuts in 2025, which means borrowing costs will remain high and put pressure on trillions in United States corporate, personal and government debt. Of concern is the $2.14 trillion in corporate debt that matures next year. However, S&P Global called the problem manageable in a recent report as companies have taken advantage of favorable refinancing conditions this year, reducing their load by 11%, of which about 41% is in the speculative grade. Corporate debt issuance in 2024 totaled $1.9 trillion by November, up 29% from the same period last year, according to the Securities and Financial Markets Association. Total outstanding debt now stands at $11.2 trillion, a 6.1% year-over-year increase, with Goldman Sachs forecasting issuance of another $1.5 trillion in 2025. What you see, plain and simple, is growth, John Sales, Goldman's head of investment-grade syndicate for the Americas in the company's Global Banking and Markets division, said in an October report. You see growth in the economy. You see growth in corporate America. You see balance sheet growth. And as companies are growing, they're issuing debt to fund that growth. There are also concerns about Trump's agenda, even with expectations that his platform could be a key driver of growth. One of the main concerns is tariffs, which could reignite inflation, although it remained low during Trump's first term from 2017 to 2021. Markets have been choppy in recent weeks, with the S&P 500 down over the past month as investors assess the market outlook. Brusswelles, an economist at RSM, agreed with many of his colleagues, saying tariffs are not an immediate threat, though they could pose one in the long term. Are we talking about a trade skirmish or a trade war? If we are talking about a trade skirmish, as we had in 2018 and 2020, then I am not worried about a spike in inflation. Prices will be higher for those goods that will fall under tariffs, he said. If, however, we get a real trade war, real retaliatory measures, then I would be worried.